Welcome to Show Me the Money with Michael Dirk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. On this episode of Show Me the Money by Michael Dirk, we have Mr. Steve Ludwig. Steve is president and CEO of Coastline, as well as Tasoro Turnaround Solutions and their financing fund, Veleta Capital. It's going to be a very interesting episode, and you're going to see all different backgrounds and experience levels from a veteran in the industry who's been very successful in property management, development, ownership, repositioning. Stay tuned, and I think you'll enjoy this episode. This episode was sponsored by Pan American Property Management. It's a great company, management company based right here in California with over 40 years of experience in property management, operated and owned by Rick Hegler, and his family has been in the business and really execute at a very high level. They have significant construction background, repositioning properties from top to bottom, from small rehab to mid to a very, very heavy deep gut. I've seen them take properties down to the studs before. I definitely think that they would be a great asset for you and your property if you are looking for a new management team. Rick and his team at Pan American have been excellent for our clients over the years, and definitely strongly recommend giving them a chance to earn your business. Please check the show notes for more and give Pan American a shot. This show is also sponsored by Nima Hadian. Nima is president and CEO of the Nima Group, a very powerful group at Marcus & Millichap. They are investment brokers and have a full team up in our Century City office. And Nima has been one of our top performers across the country for many, many years. I definitely recommend, if you're looking for a BOV or just a consultant, or looking to potentially buy properties, expand your portfolio, or looking to trade out of assets and talk about the different moratoriums or things happening in LA County, no one would be better to talk to than Nima and his team. Again, very extensive background, very polished, experienced, and they will get right down to the point. He's looking at a long-term relationship rather than just a transaction. Again, give Nima Hadian and his team at the Nima Group an opportunity, and I don't think you'll be let down. Thank you. All right. Good morning, everyone. Welcome to another episode of Show Me the Money with Michael Dirk. Today we have a very special guest, Mr. Steven Ludwig. So Steve, welcome to the show, and thank you for coming down.
Great to be here. Thank you for having me.
Thank you very much. And you have a pretty extensive resume, so I would like you to actually, instead of me reading through it, if you can please touch on some highlights for the watchers here of the show, that'd be great.
Absolutely. Quite the honor. I appreciate it. So my name is Steven Ludwig. I am the founder and CEO of a vertically integrated family of real estate companies, which include multifamily and industrial value add. We have a land entitlement and development division as well. So between those two, we've done about $1.5 billion of acquisitions of existing assets, and we have about $500 million of land entitlement and future development in our pipeline right now, with a heavy focus on Southern California and the South Bay of LA. And over the years, we've vertically integrated, so that includes property management, where we have about 80 people on our team running all of our assets. We have a licensed general contracting business that does turnkey apartment renovations. So we have a corporate team of about 30 and then hundreds of people out in the field swinging the hammer every day. We have a building materials company called Tasoro Products, where we manufacture every product that goes into a living space except appliances. That allows us to control the quality and supply chain of all the renovations that we're doing, not only for our own portfolio, but also for our hundreds of third-party clients as well.
Great.
We then also have a lending business called Veleta Capital, a finance business right now focused on the small balance $2 to $20 million bridge lending space, and we're making loans pretty much throughout the West Coast and Sun Belt.
Great. Wow. I must say, just founding these 4 companies, doing all that, balancing it, having a family, how do you find time to balance that and, work with all these companies? Do you have great heads of these companies? Is that what you're doing to make sure this works, smoothly
Absolutely.
every day?
It's a great question. I mean, there's no way you can do everything on your own, right? You have to, in my particular case, I've been very fortunate over the years to have fantastic partners. And my business theory has always been to have everybody have more or less equal ownership, the different partners in the different businesses, so that everybody is equally incentivized.
Yes.
And pulling the same rope equally as hard each and every day.
Right.
Whether I'm in the office or not, everyone has each other's backs 100% of the time.
Sure.
And that's really critical. Still every day, every hour jumps from one business to another, one topic to another.
Sure.
And so it's interesting. You mentioned I have 3 kids, and one of the kids has got a low form of ADHD.
Okay.
And as you're going through that as a parent and learning the ins and outs of it,
Yes.
really when I'm talking to a lot of the professionals in the space, I'm relating to what my son is going through, because back in the day in the 70s and 80s, you were just a kid with a lot of energy.
Right, exactly.
And it wasn't like, hey, let's medicate. I'm like,
sugar.
hey, let's give him a baseball or a football and tell him to run for an hour and burn off some energy.
Yeah.
And then you did your best to control yourself when you're sitting in the classroom. For me, staring at the walls, talking to everybody.
Sure.
And so what some people say is, that can actually be your own superpower. And so call it undiagnosed ADHD.
Right.
It really allows me to kind of handle all the different spinning plates each and every day.
Sure.
And enjoy it and not lose my mind.
Right.
But thrive in it.
Yeah. No, the life-work balance, my daughter's 7 years old, so I get it. It's full-time all the way through, and, working with the team, you're working with your teams, your companies, and then being a great family man is always it's always a balance for sure.
There was always a phrase that I loved. Like, I would be up early on the weekends waiting for a sports game, and the only thing on TV was like bass fishing on ESPN or like the ESPN workout videos in the morning. And there was one person, and he would always get up and be like, it's 6 a.m., no rest for the wicked. And I was like, yeah, no rest for the wicked. That resonates with me.
Exactly.
And so I just kind of keep that going each and every day.
That's great. So what has the last year looked like at Coastline, and maybe into this year as well, that we're obviously probably, half to 3/4 of the way through this year? What does that look like? What, are you focused on acquisitions? Are you in dispositions? I know before the show started, we talked a little bit about, an exchange. So what does that look like for Coastline?
I think our experience in 2008, and call it a few years before and a few years after, really helped shape our company post 2008. At that time, and call it the early 2000s, we were a one-trick pony. We were a multifamily value-add company that outsourced everything. And when 2008 happened and the rug was pulled out from underneath our feet, and all of our investment values, went down dramatically, and our promotes dissipated, we were left to wondering, how do we survive? Right. And so the first evolution was, let's get into property management. And so we built out a property management company for ourselves, but then also we started doing it on a third-party basis. And then came the other businesses, construction, building materials, lending. And so that allowed us to tremendously diversify where our revenue streams came from. And so today, if you're just a value-add apartment investor, you've been pretty dormant for a while.
Right.
We certainly have been.
Yes.
I'd say, starting really in 2020, we saw that apartment values were very frothy. Mm-hmm. And we actually switched gears quite a bit to doing service-type business, construction, building materials, lending. And
when you say construction, are you talking about ground up, or are you talking about
renovations? So our company, Turnaround Solutions, does turnkey apartment renovations.
But you're not doing ground up.
We're not doing ground up.
Okay,
that's correct.
Got it. Okay.
I'm not ruling it out for the future, but
Right.
today we don't.
Right.
As long as I don't have to run a day to day, I'm happy to get into the space.
Get the entitlements, permits.
That's right.
No fun.
So what we did do, starting in 2020, was we saw an opportunity to buy industrial buildings, and those values hadn't run up yet pre-COVID.
Okay.
So we started looking into the space of buying industrial buildings that were on large pieces of land where the industrial site itself was more or less outdated or obsolete, and that there would be a great opportunity to tear those buildings down, or rezone, re-entitle the land for high-density multifamily, tear those buildings down and build. Because what I started to see was the issue in Southern California isn't, hey, we need a lot more renovated apartments.
Right.
It's, we just need more apartments.
Yes.
So as more and more people flooded into the value add space, and everybody's on Instagram and pitching, all different types of ways of, hey, you can buy apartments with everyone else's money. I was like, this has become such a commodity space.
Right.
But it takes a lot of knowledge, skill, experience, and risk tolerance to go into the land entitlement space.
Yes.
And so, again, brought in a friend of mine. We partnered. He partnered with my groups, and we started buying these types of investments.
Okay.
And so, in pretty short order, we gobbled up 5 parcels, 2 of which we combined. And so we have a handful of sizable developments happening right now in the South Bay of LA. Nice. And historically, I mean, when you look at the demographics of the South Bay, it's 94% of the housing stock is 1990 or older. And you're talking about 18 cities that comprise almost 900,000 people. Wow. It's starved for housing. Yes. And we're also one of the largest landlords in the South Bay. So we really have our boots on the ground and understand the economics of the greater South Bay community. Sure. And so that's kept us really busy right now. Okay. And our projects range in size from 72 units to 400 plus units. So that's been exciting.
That's sizable.
Yeah.
Is any of that in the affordable space, or is it all market
There's
rate?
a component. It's market rate with a component of affordability.
And that probably helps you get your approvals and entitlements and everything to have the affordability.
Absolutely.
Yeah.
Absolutely. It's imperative, and it's the right thing to do.
Sure, of course.
For the community is affordable housing. It's one of those head scratchers to me. One of our projects, I went to the the county of Los Angeles, and I said, hey, we've got 35 existing apartments here. They're pretty old and beat up. Why don't we knock them down and build 400 affordable units, 200 units per acre? Sure. There's precedent in the community for that. Let's do it. Right. And the answer was and it's transit oriented. You get a bus line that runs right through. It's right next to a college. Sure. And the county was like, no, we don't want to see 35 apartment units go away. And it's like, I'm not trying to knock down 35 apartment units. I'm trying to build 400 low-income units. Right. And until you start to get, government buy-in that those types of things have to happen. Sure. Yes. You can't just go buy contaminated landfills and hope that a developer wants to go through that. Right.
Kind of like downtown LA with the schools and everything that's happened over the years. That's tough. That would be so great for people, and allowing you to do that would really benefit so many of the residents as well. It's shocking that they wouldn't buy into that.
There's endless opportunities to create tremendous housing throughout Southern California. Yes. But there's everybody said, you don't want to build in Southern California. The regulation, the red tape, it's ridiculous. And, as an outsider, I was always like, you're probably just not thick-skinned enough. Well, pretty short-sighted on my end, as there's lots of smart people who are very well capitalized to take on entitlement. Right. And it's like people just get ground into submission. Yeah. And people who've been in land entitlement forever go, God, I like the value add game. And people like me in the value add game for 20 years, it's like, well, maybe I want to do something a little bit more exciting and difficult. Right. So I'm going to go into the land entitlement game.
It's lucrative if you can pull it off, but boy, if you can't pull it off, it becomes you're almost fighting against yourself.
That's right. Well, part of it,
like Don Quixote, fighting the windmills.
Part of the way that we tolerate the risk is that we do covered land plays. So we have in-place cash flow that's covering the, call it 50% loan to cost that we use to acquire the land. Sure. So if it doesn't work out, we thought that we were buying, the sites, the existing new sites at a good value. Right. So it still could be a value add play, but then there's the huge potential for the rezoning and entitlement. Yes.
And the rezoning is huge, and we're seeing that, in the office space, right? That's where these office buildings are 40, 50% vacant. I was reading an article this morning, New York, Boston, 40, 50% vacant, and how do you repurpose it? How do you do that? Changing all these things. We've had a lot of other guests on the show that have talked about this, that, windows not opening, adding bathrooms, ceiling height, all these things. People are like, oh, we'll just repurpose it, but you need to rezone it. There's a lot of things that need to be done that, it's not just a snap of fingers.
One of my architects told me, Steve, we're doing a couple 100 unit apartment development, and we've already had 151 change orders from the general contractor.
Whoa.
And we just poured the foundation. And I was, as you make your comment about office conversions,
Right.
well, that's like got plans and probably a contract with a max price on
Sure.
it. And now you're talking about reconfiguring an office building where there probably are no plans anymore.
And it's probably obsolete, built in the 70s or 80s anyway.
I just can't imagine when you actually get into that.
Right.
I mean, the number of change orders and the cost escalations.
Yes.
I mean, where you finish versus where you pro forma'd.
Sure.
If you're
Electrical systems, plumbing, like everything, it's just endless.
drilling through core concrete with steel rebar that may be corroded, maybe not corroded. I mean,
Right.
who knows?
That's why I think a lot of these office buildings, the highest and best use might be bulldoze and start over.
That's right.
It's sad to say that, but
That's right.
realistically, that might be the case.
That's right. And it's going to be a long time before anybody gets to a point, especially the lender, if they had to take it back,
Sure.
or prices to continue to fall far enough that land value is what it's worth.
Right. Exactly. Yeah. Land value less the bulldozer coming
Yeah.
in, I guess, is the.
That's
you
right.
know, it's sad to say, but that's reality.
Yeah.
And some people need to, unfortunately, see that, and maybe not. I don't know.
It's exciting though.
It is
exciting.
Well, the nice thing about real estate is, as you've been in it so long, right? I mean, you and I have been doing this a long time, and it's so dynamic and so changing all the time. And the market is always ever changing every day, and it's never the same. And I've been doing this 24 years, and I'm learning every day. Every day I'm learning something new, which I love, and it keeps you so, in tune to the market.
Yeah, there's a new curveball every day. I mean, whether it's government regulations, the capital markets,
Yeah.
the call it supply of new construction coming online,
Yes.
supply chain issues,
Yes.
labor issues, like.
Right.
One of the areas that we're looking at, not only are we looking to add new housing, but we're trying to think creatively on how we add that housing.
Okay.
So you have traditional stick built, and now you have the emerging construction field of modular, which is really exciting. Excuse me, I'm going to take some water.
Please,
Or
yeah.
choke on the microphone
Yeah,
here.
yeah. It's all right. Yeah. Yeah, the modular housing, that's interesting. You say that in Tennessee, where I'm living right now, there's a lot of these micro home communities that are there that seem to be a very, big up and coming and, very valuable. And these small little homes are selling for like $50,000 to $80,000 for like 300 to 400 square foot homes. And that's a great affordable price for a lot of people, who are working today, day in and day out, who are having trouble to afford rent. Now they can actually afford a home if there's some good financing that the developer can set up for them. And, it's a great solution for people because the cost of living for this next generation of the people in their 20s and even early 30s, it's very expensive. And for people to get ahead and actually own real estate, which has been the American dream, I don't know what it is today, what kids are looking at, but I think it's great to have them get a piece of, ownership and a pride of ownership.
If they even want it.
Right.
If they even want it. When you look at, the Gen Z and what their tastes and preferences are, and, I was reading an article the other day and how, marriage, one of the oldest institutions in our country is being frowned upon by the younger generation.
Oh, wow.
And how, there's starting to post about, the single life and how great it is. And it's not, men or women, it's both.
Okay.
And I'm looking at myself and I'm going, that's alarming, as I've been reading a lot about population demographics globally and how the future of different countries really depends upon the younger generations repopulating their countries and creating, the labor force.
Right. Yeah.
And if you have, people, denigrating the institution of marriage, that's going to lead to, lower birth rates and problems for countries worldwide.
Mm-hmm.
But, going back to the modular, in terms of like problem solving, and you dive into modular, there's stick built, there's steel frame, there's steel tubular, there's the logistical component, and then there's the lending component and who will finance modular.
Right.
So it's like, there's a lot of evolution happening in the space, and then there's prop tech that's coming in. And so in times like today, where there's not, transactions are down 75% in
Yes.
city of LA and
Yes.
certainly, LA County and Greater California.
Right.
And so it's a great opportunity to dive into areas and learn where you otherwise may not have had the time when you're in like heavy transaction volume cycles.
Right.
And you're
drinking out of a fire hose.
Yeah, that's right. That's right. You're just, where's the diligence? Where's the lending? Where's the equity?
Right.
What's my closing date?
Yes.
What's going wrong?
Don't miss a day, or we're going to cancel, or we're going to hit you for a
That's
fine.
right. So you're just living on like, in DEFCON 5 anxiety world, which I feel like we've been doing since like 2011.
Yeah.
And so the slowdown, I think, is good in a lot of ways.
It's been so extreme, though. It's gone from 6th gear into 1st gear like overnight. That's been I think the biggest thing in the transactional world that my team and I are seeing every day. Being with Marcus Millichap and seeing that platform across the whole country. Seeing just a plethora of activity, low interest rates, $5 trillion thrown in overnight, and then all of a sudden, boom, like snap back, and everyone's standing up, like looking around, like what just happened?
Right. Or for us, instead of drinking out of 5 fire hoses with each of the companies, now we're drinking out of 4.
Sure.
Right.
Yeah. Right. Exactly. I mean, you have your hands in so many different things, and labor, managing all these teams, construction costs, repositioning assets, rents and regulations and whatnot. I guess that kind of leads into the next part here with interest rates and what's going on. How is that affecting your business? How have you managed that? Because a lot of people now are obviously stunned because of obviously the Fed has hiked rates 11 times. They're meeting, here in the near future. And, what happens? Do they pause? Do they keep going? I mean, to manage this and to manage refinance risk for people that are looking to do this and take things out, people who have rate caps on their loans, or people have fixed rates that are rolling to adjustable rate. How have you and your team managed this? And, what do you see for the forecast on interest rates and how it's going to be affecting the values?
Sure. Well, from the perspective of having a lending business, a private credit business, it's been great. We foresaw that interest rates were going up. Lenders were pulling out of the market, traditional lenders, banks, et cetera. And then that created a pathway for us on the lending side of the business. So that, that was great. And that's part of the diversification plan that we had, kind of that evolved post GF. What do we call it? The Great Financial
GFC.
The GFC, the Great Financial Crash.
Correction.
Crash.
Or event, GFE,
right,
great financial.
I don't know. I'm not good with that. I'm not good.
Whatever you want to call it.
If there's one thing I've learned from the land entitlement business, I don't understand acronyms, nor can I remember them.
Right.
And that is a heavy acronym business. That's like the military side of the real estate world. If you don't know the acronyms, like you're lost.
Right.
You're lost.
And people look at you like, wow. Especially starting out in the business like I did at, Marcus here 21 years ago. People were throwing acronyms, all the senior brokers in the office, and I'm like walking around like, oh God. What does that mean? And I'm like, if I ask them, I'll sound dumb. So it's amazing. And I always tell young people in the business, please ask questions, never feel dumb. It's always important to learn. And I try and help and give back and host workshops for a lot of the young brokers in the company. And I think it's so important.
At the beginning of your career, you care what people think. And as you continue on, you care less. So I was the one that like, on a call with one of the cities we're entitling, and everybody was throwing out. We had the EIR consultant, my partner, the city plan. I mean, everyone was throwing out acronyms. And unlike I never did in class, I was like, excuse me, like what does Skippy stand for? And it was like the record stopped and everyone was like, you don't know what a Skippy is? And I was like, no, I don't know what a Skippy is. And then everybody actually didn't know what the actual words were either. And so I was
Everyone's
like, well,
there playing poker.
I'm the developer here. And so none of this, no one's making money without me kind of driving this train.
Right.
So what I'm going to request is a glossary. And I want everyone,
funny.
like if you throw out an acronym for the first time, it has to be glossarized, with a definition.
That's funny.
Because like you probably don't know it. I certainly don't know it.
There's someone else in the room here that doesn't know it either,
and I'm paying everyone's bills and I'm the developer. So
Right.
nothing happens without me at this point. So this is what I want.
Sure.
I didn't get it. But I do get the right.
You just got some dirty looks?
No, I got a lot of dirty looks.
Yeah,
but like
of
now
course.
people actually are like, they say something and they're like, Steve, that means they come prepared. So that's
really funny. Oh my God.
But in terms of, interest rates and what that means, again, Veleta is doing well. It means something different to every business.
Right.
I'm kind of working backwards to the investment side. Veleta, it means that we see a lot more loans and have the opportunity to lend on things that we may otherwise not have because traditional lenders are out of the market. On the building materials and construction side, we're still incredibly busy because there had been such a huge run-up in rental rates. Our building materials company, Tasoro, we sell those products nationally.
Okay.
And so we're seeing a huge uptick in business as people are still renovating and frustrated with supply chains, looking for new sources, worried about escalating costs, trying to figure out ways to bring down their costs.
So you're buying it in large quantities.
We're manufacturing.
You're manufacturing.
We're the brand. So we're contract manufacturing everything, and we're just basically, it's our specific line. And what we're doing is, product comes from manufacturer to our warehouse in our box and goes to you, the developer, contractor, subcontractor, owner, operator.
Okay.
It skips that, branded product that comes in, goes to another retail wholesale chain. And
instead of going to Home Depot or Lowe's, it goes to you. You put Tasoro's name on it.
We don't care about the DIY market. We care about high volume people.
Okay.
And so we have a low cost of goods sold per unit that we sell, whereas a major brand name made, big corporate offices, fancy jets, global sales operation, halftime commercials for the Super Bowl, for their faucet.
Right.
Their cost of goods sold per unit is much higher than ours. We both mark ours up, call it the same markup, and then we sell to you. They resell to a Home Depot who has their corporate cost of goods sold, their additional 40, 50% markup.
Right.
And then it goes to your contractor who buys it point of purchase, maybe marks it up again.
Right.
And so we're able to save our clients 40 to 50%.
That's a huge.
Oftentimes, I'll call it 30 to 50%. Some people are pretty good at buying, so they only get 30% savings.
Okay.
But then the other thing too is because we don't have that second level of markup and corporate overhead, we can actually make much higher quality products. So, I think I live in a pretty nice house. I'm putting in my house the same products that I'm putting into oftentimes my workforce housing.
That's great.
Apartments.
That says a lot.
Yeah,
that
because
says a lot.
The widget, I hate to say it, but this shirt, it's a really nice golf shirt. It probably costs $3 to make. What did I pay for it? Exponentially more.
Yes.
Right.
Yes.
So it's all the branding and distribution.
Right.
But the actual widget and everything doesn't cost anything to make.
Right.
And we've kind of cracked that.
That's great. And where are you manufacturing your products?
We manufacture, I think, in 12 different countries.
Oh, you do? Okay.
And 50 to 60 different manufacturers, and then we bring it all into Gardena, California.
Okay.
And then offload, repack, and distribute nationally.
Wow, that's great.
So that business has been thriving along with the general contracting business because turnaround solutions because labor is hard to find. We have a great labor force, and so we're getting, we're at max capacity on that front. And again, people chasing the higher rental rates that occurred, during COVID and post-COVID.
Yes.
And then on the value-add apartment side, we've been pretty quiet the last 3 years because of what we thought were frothy prices, and then interest rates started rising, and we said, "Hey, we've seen this game before.
Yes.
We watch what happens. When underwriting doesn't make sense." But there's still a huge availability of equity and debt capital. This is what leads to the run-up, which led to the GFC, GFE, whatever you want to call it.
Right.
And so let's throttle back. But at the same time, there was that persistent problem of a housing shortage. So we were buying the industrial land with the goal of converting it. And now that we've gotten one project approved and two others, I'd say we're reasonably close. Call it first quarter of next year, we'll have another 600 units entitled.
Right.
Now it starts to, you're kind of getting back into the financing equation.
Sure.
And you're saying, okay, well, do we want to build these? If we're going to build these, what is construction debt going to look like?
Right.
And it's not pretty.
It's expensive.
It's not pretty.
For prime, prime's at 8.5. Probably going to go to almost 9.
Yeah, it's not pretty.
Treasuries are mid-4, SOFR's 5.25, 5.5. It's
when debt's not accretive,
right.
It's just all debt is doing today is lowering your down payment.
Right.
but it's not accretive.
Right. Exactly. Yeah. Instead of all cash, it's 50% down. It's not that.
But
not
I'm just
that
saying,
beneficial.
it's again, when you look at your returns,
Right. If you're not leveraging on a basis for a real estate transaction, it's like, well, you're scratching your head, like what's going on here?
Yeah, and especially on whether it's value add or development, I mean, yes, you're pre-funding an interest reserve, but like that's just accruing and compounding, and
Right.
that interest reserve has grown dramatically.
Yes.
I'm seeing a lot of developers who are, it's hey, let's build it and pray that we come out on the other side when the world's better and we can refinance at a lower rate.
Right.
That's a little scary. But, again, we bought really well on our development stuff. So, we're kind of right on that, I feel like Humpty Dumpty,
Sure.
sitting on top of the wall.
Right. Yeah, no, I know. And Jerry Marcel, I think you know him in the
Yes.
South Bay. He's been on the show before, and he's always told me, Michael, over the years, the way you make money in real estate is when you buy it.
Yes.
And I'll never forget that when he told me that over the years. And I was like, wait a second. When I was starting, I'm like, when I buy it, I make money. Wait, no, it costs me money to make it. How does that work? But if you buy it right, that's what it's all about. It's not about that exit.
Yeah. And then, years ago, one of my investors, who was a real estate entitlement attorney, takes me out to lunch, part two to what Jerry said. So the attorney friend looks at me and he goes, Steve, do you want to be wealthy or do you want to be rich? And I kind of scratched my head and I was like, what's the difference? And he goes, great question. He goes, I'll tell you the difference. Wealthy people never sell.
Right.
And
That's
I
an
think it
excellent
took me
point.
like 8 years to kind of truly understand that, because
Right.
I sold a bunch of things.
Sure.
And then in hindsight, I was like, shouldn't have sold that.
Right. Yeah. No, you're 100% right.
I mean, I think someone just sent me a deal, South Bay of LA. I sold it to this person who's trying, to the owner who's now looking to resell. I was like ringing the cowbell that we sold the building for, $8.5, $9 million after we paid $4.5, and it just came back to me at like $14 million. And I was like, so if and the guy didn't raise the rents, he's never put a dollar into the building. So if I just didn't sell and did nothing,
right.
I would have made another $5 million. That's cool.
That's a lot of money.
It's a lot of money.
That's a lot of money.
And as you move on in your career and the, years and decades roll by, that wealthy versus rich comment really started to resonate.
Right.
But when you're like, just getting going, late 20s, and you're just like, yeah, I could buy this stuff and I can
Right. And you make a big paycheck.
I can put some paint on it,
Right.
Clip the hedges,
A little lipstick on the pig is what they
sell
call
it,
it.
make
Yeah.
money.
Right. Yeah, you get a huge paycheck and it's exciting, but not having your money work for you over the long run, right? That's the creation
That's
of wealth.
right.
Being rich is, okay, you buy things, you sell it, you made a lot of money, all of a sudden you just pay a lot of taxes, and you have to finance all the things that you just bought, taxes, upkeep, everything. That's the rich guy. The wealthy guy sitting next to him is the guy who bought real estate, invested in it, rehabbed it, and now has cash flow to sustain the full lifestyle.
That's right.
I think that's really the difference between the rich and wealthy.
I think the worst thing that ever happened to real estate was when Wall Street came in and started talking IRRs and saying, hey, you got to compare this asset class to the other asset classes we're selling you,
Right.
because it's about IRR, right? And so now everyone's so conscious about time value of money.
Yes.
Right?
Discounting it back to present value.
And it's like, well, real estate is an asset class. It's a part of your portfolio.
Right.
And you should buy it and you should, sit on it for decades and decades.
Right.
And, that's how you become wealthy. It's like
Right.
it's really, if you have the staying power, it's probably one of the easier games to get wealthy in.
Right.
And I feel like over the years, I've talked to so many lawyers and doctors. I'm like, oh, you have such a great practice. They're like, my job kind of stinks, or I love it, but where I really made my money over the years was in real estate.
Yes. And I have it's funny you say that. I have a ton of clients who are in the medical profession, and they have done much better in real estate than they have in their everyday practice.
Yeah,
So
they had a means of income.
Right.
So they didn't have to churn that real estate for IRRs.
Right. Exactly.
And they just let it,
That's the exit strategy. Instead of waiting on a pension or waiting to retire when they're 80 years old at their desk, they can enjoy their lives with their children, maybe in their 50s or 60s with some good cash flow, and may pull back on the, everyday business of being a doctor or lawyer or whatnot.
Right.
Right.
That's right. And you see it
Yeah.
routinely.
So tell me today, Steve. So based on all those points you just made, today obviously you're following the wealth, so you're a net buyer today for real estate, or are you a net seller? I guess I just want to ask that question.
I feel like I'm a Netflix guy today because, I feel like I'm more watching what's happening and trying to figure out, which way the wind's going to blow harder. There's still so much uncertainty in the marketplace.
Sure.
That I kind of do feel like more of a spectator. Okay. You see the real estate news, so-and-so bought something, and just the acquisition guy in me, the hunter in me.
Yes.
I get a little jealous, and I start.
Because there's still deals going down.
Yeah, all of a sudden I start calling people, and I'm like, hey, I kind of, want to, fire up the machine again and start buying. And then someone's like, oh, here's a 4.25 cap that could go to a 6 cap. And I'm like, okay, well, my debt's 6+.
Right.
So I can,
let's start at the 6 cap and then tell me where to go from there.
That's right. So again, I'd say the value add game to me just still doesn't feel attractive.
Right.
The development game feels very attractive. So I'm very much a net buyer.
Net buyer today. Okay.
On land, on sites that I can entitle. I think there are going to be some really interesting opportunities from peers in the development space who are capitulating.
Yes.
Because they bought too high, their interest rates jumped up on them.
Right.
Construction costs escalated, change orders have hammered them, and they're stopping either at RTI or mid development. Starting to hear some of those and see some of those. So that's attractive to me. I would love to sell deals where, maybe I have a joint venture partner and there's an IRR-driven preferred return.
Okay.
In Southern California, the preferred return that you have is going to be higher than your cash flow.
Sure.
So every day, once you've gotten to a point of semi-stabilization that you're not selling, you're just eroding your promote on the back end.
Sure.
So I would love to sell. However, prices have dropped, so it's not necessarily a great time to sell.
But the property you're buying arguably would be lower as well. Should be.
Yeah, that's right. If you were in a perfect world,
because you're selling high, you're probably buying high. It's always hard to.
Again, I feel like if you're selling today, it's more because you have to. And so, but if you're buying, right, it's a desire, not a necessity.
Okay.
So it's like the buyers have to almost pay up to get into something.
Well, if you're doing it for the long run as well, that's another aspect of looking at over 10. If you're looking to make money quickly over the next 3 to 5 years, real estate, I never tell people, be careful. It's not a commodity. It's not a stock where you're sitting there day trading.
But I'm not seeing prime assets come up.
Right.
So the assets that I have seen, there's a lot of wonkiness to them.
Sure.
Right. Again, problem situations where someone's trying to get out. Mm-hmm. And so, if there was this pristine, shiny new asset, in a sub-market that I loved at an attractive price, I'll pounce. I just haven't seen it.
Sure. Right. I think the opportunities with the interest rates, we talk to clients and they're like, oh, rates, it's an election year coming up and, rates are just going to come down. A lot of these values that people bought between 2020 and 22 were based on these very low interest rates and the government artificially buying treasuries as well. I don't think we're going to have that. So those
higher longer.
Right.
Higher longer.
Exactly.
I think
and these rates are going to adjust, and these fixed periods are going to adjust in end of 24, 25, and 26. So these rates that we put on there for a lot of our clients, high 2s to high 3s will now be, rolling to 7 to 8%. So a lot of clients need to look at what they're rolling to.
And higher interest rates doesn't mean the economy is going to tank. I was listening to something the other day, and I can't recall exactly what it was, but during the Clinton kind of boom time economics,
yes,
the interest rates were 5 to 6%.
Right. Yeah, so 6%'s kind of been that 5 3/4, 6%'s kind of been that.
But you could have an expanding economy and higher interest rates, like what we just came out of.
Right.
That was unique.
It was an anomaly.
Yeah.
But it caused maybe almost an asset bubble, and people are going to need to really manage this on their rollover risk for debt.
Absolutely. Look, for everyone, anyone that bought in, call it, 19, 20 to, 22.
Yep.
If you didn't lock down your debt for 10 years, and you don't have huge value add upside
Yes.
opportunity, you've got a problem, and you can see it playing out. I mean, all the news is everywhere about all the people that bought a ton of stuff and
Right.
had 70 to 85% LTV, floating rate debt.
Right.
Now there's supply chain issues coming into the market, and rents are flatter, going down a little bit, and oh my gosh, the sheen is off. The major markets that we're talking about,
Right.
Las Vegas, Phoenix, Texas.
Yes. So many markets.
So many markets. For us, we have always been, post 2008, again, learned big lessons. When we bought something, we're looking at doubling the rents, not $200 to $300 pops per month. It's like $700 to $1,500 a month increases.
Because you're looking at the long game versus a lot of people are coming in making that quick rip and then looking to sell it quickly, I guess.
We do heavier renovations.
Right.
So there's only so much you could do to a 60s, 70s, 80s vintage exterior of the building that you're going to get a return on your investment.
Sure.
But I always say people spend 99% of their time in their apartment, in their actual apartment.
Yes.
1-2% in the
kitchens, bathrooms, right?
Yeah, but I'm saying, so like how often does someone, as compared to their total time on site at the pool, at the gym,
right,
et cetera, in the community lounge. Or
that's an excellent point. Most people are working; they don't have time to sit around.
So 99. So we've always said, hey, like the exterior of the building, like let's what are things that matter? Like operable windows, yes. Do I want to see does someone want to see the popcorn ceilings anymore? No. Does someone want a washer and dryer? In
That's
their
huge.
apartment. Absolutely.
Yes.
That's the number one amenity. Like if you said to me, would you rather have a gym or a washer and dryer in your apartment? Washer and dryer.
For sure.
Because I had the apartments, where I lived, and they had every amenity. And back in the day, because you were working so much, I grew up in Boston. So my mom would send me to camp with these Coho hockey bags.
Oh, I remember Coho.
They were great. They were the biggest bigs you'd ever seen.
Yes.
And what I learned is you could put like 75 loads of laundry in them.
Right.
And when you're in your 20s, you don't think of back issues. So I'd lug this like 300-pound laundry bag.
Yes.
And take up every single washer and dryer for 3-4 hours and get all my laundry done.
I used to do that in college. I know exactly what you're talking about.
And so like now it's like, gosh, if I had to do that today, miserable. And it was even miserable then. You could just do it.
Yes.
Right. But
now it's in your apartment. You throw the washer, right? You go to work, you come back, throw in the dryer, or do a couple loads in the morning. You don't have to be forced and everything.
That's right.
So, and leave your stuff, wait around for hours and hours. It's not efficient. So having it in there, I completely agree with you. And
but it's not even that simple anymore. It used to be, okay, we're going to put washers and dryers in. We're going to go pull all the permits and do the design, do the MEPs, pull the permits. We'll have it done in 3 months.
Right.
That 3 months is now turned into 12 months.
It's huge. Carrying costs and all that too are massive.
Yeah, absolutely.
That's really where it adds up to investors.
Absolutely.
Yeah. Oh boy.
I get us off track, and that's the 80.
No. Don't worry.
Me that just
I
takes us everywhere. You got to keep us on track.
I will. I'll keep it on track.
We'll be talking bobsledding in 30 seconds if you let me go.
Exactly. Cool runnings. So my favorite part of the show is everyone in their career has a very big high that they remember, maybe one or two, if you can just touch on one. And then most importantly for the viewers of the show, I would like you to talk on something that, not so much a regret, but some very low in your career and how you fought back to persevere through it. Because I like to, especially the young watchers on the show, I like them to see someone as successful as yourself, what you've done to bounce back. So if you can touch on those two.
Sure. I feel like it's just been a series of highs and lows. It's really easy for me to kind of go through that as the early part of my career. I'm 26 years old. I just recently moved out from New York to California, and I was working for, again, this real estate private equity company. I've been there for 2 years. I'm doing acquisitions and asset management, but I'm not really feeling like this is where I'm supposed to be. And so I'm kind of dabbling into the space of, syndication, and someone that came in to pitch us on an investment asked if I would moonlight and help him put together offering memorandum to help him raise equity. And I was like, sure, I'm happy to do that. He's like, I'll pay you, $50 an hour. And I'm like, look, I work 110 hours a week right now. $50 an hour doesn't move the needle for me. Like
Right.
I want promote.
Yes.
And he's like, sure, no problem. I'll give you 25% of the promote and you moonlight. And I was like, oh, hell yeah, I'm in. So, didn't sleep for a few months.
Right.
Anyway, the company I was at was like, Steve, look, we kind of see you have 1 foot in, 1 foot out. So we're going to help you and kick that other foot out. Like you're being laid off or terminated or whatever it was.
Okay.
And I was like, okay, like that's fine. No issue. I know where I'm going next. And the person that I was moonlighting for, I said, look, I'm all in. Like,
Okay.
let's do this.
Yeah.
I'm done, at the private equity firm. And he's like, great, I'll pay you $3,000 a month for 3 months, to get this deal done. And like within 2 weeks, the deal falls apart. And I was like, that's not good.
Uh-oh.
And so he goes, look, if you can find another deal, I'll pay you $3,000 a month for 3 months. Well, when you have your back against the wall like that, like you think working 110 hours a week was a lot, like this was a 24/7 game.
Right.
And anyway, I find a property, 170 units in Sherman Oaks, California. I find a private equity firm who was willing to put up 80% of the capital. My partner, who was, I was 26, he was 47. He put up or syndicated the private side, the 20%. And lo and behold, like we bought a $17 million apartment building. And that was fantastic. I was ecstatic. I made no money from it. When I got the acquisition fee, he was like, we'll split it 50-50. Mm-hmm. He's like, less the cost for your desk in my office. I have a receptionist. I have a phone line. You can pay. So all of a sudden he hands me a check for like, $8,000 after we just bought a $17 million apartment building. But
wow.
I didn't even care because I was so excited to be in the game.
Yes.
We had 4 more deals in escrow. And on a Monday morning, I get a phone call from my partner's business partner in his mortgage brokerage company. And he says, I have terribly tragic news. His name was Steve as well. He goes, Steve died yesterday in a car accident.
Oh, no.
And that hit me like a ton of bricks.
Wow.
And from the high,
Yes.
now all of a sudden, the exact opposite of I'm 27. I've got no business partner. I've got 4 deals in escrow. I've got a widow and her family who are trying to figure out what's going on. They don't
Right.
really know me.
Right.
And they're digging into all of his things with their attorney and questions coming, and understandably so. It's,
Sure, of course.
they're in a world of turmoil and pain
Yes.
and hurt, and I'm just, potentially a drain on precious family resources.
Right.
So that was a really difficult time, and I'll never forget my current business partner, his dad, Gary Friedman, amazing friend and attorney, calls me into his office and he says, Steve, look, I'm gonna tell you what you need to do going forward. This is like, he was my first phone call. Gary, my partner's, passed away. I've got this one investment. I've got, other deals in escrow. I don't know what to do. And he pulls out a sheet of paper and he writes down like an action plan in 10 bullet points. And he's like, you're going to call your joint venture partners. You're going to call this. You're going to, and point number 10 was, you're going to be really emotional at times, but you are now a grown-up and a businessman. So when you feel the need to cry or be emotional, you're going to walk out of the room. You're going to go in. You just say, excuse me, I need a second. Go into the bathroom. Mm-hmm. Cry your eyes out. Scream. Do whatever you need to do. Clean yourself up and walk back into that meeting and show them that you are in command of your situation. And just that little part of someone being so human and understanding mm-hmm. where I was at as a young
right.
man, that this was super emotional,
especially
gave me the courage.
From someone who's been there,
yeah,
and someone with that kind of experience, they have a rock at your side.
To give me the
priceless.
Like that gave me the courage and the strength, and like just knowing, like, hey, here I am, and I thought I was this young, big, tough guy, and he's like, Steve, like, you're gonna cry. You're going to be emotional. Like, I see you. I see who you are. You're this, tough guy from Boston. Like, this is bigger than what you are right now.
Yes.
And so that really empowered me, and I'll just never forget that.
That's great.
So it was like this range of emotion.
Yes.
That really defined the early part of my career, and having to go through and that was 2003.
Okay.
So really 20 years ago. And now it's like I look back.
That's when you started Coastline, right? Was it 2000? Yeah.
Yeah. Well, yeah. And it's 20 years later. And now I'm 47. And my first partner, Steve, was 47, married, 4 kids, 10 and under.
Right.
When the tragedy happened. And it just, I look at it and I go, boy, now I'm 47.
Right.
I'm married with 3, kids, 11 and under.
Yes.
And it's like, man, time flies so fast.
Right. And it's something that can happen in a blink of an eye.
Yeah. Yeah. So
it
really makes you appreciate every little moment.
Every day.
Every day.
And try and help people in need, people who are down, people who are struggling, especially in the business and whatnot. I always try and go out of my way. I know you do as well, and try and just help these people instead of, people are really trying their best, because you just never know what people are holding in their hearts every day and what they're dealing with. So I think it's imperative that, we all do a little bit. We'll help each other. And that's great that obviously Gary did that for you. If there are people who are watching this who are in the brokerage industry, there's probably a few of them out there who have called me and said, hey, Steve, this is, Bob. I see your property on X, Y, and Z Street. What can I sell it for you? Yes. And like most of the time when I get that call, I hang up right away. Okay. It's like you're just calling me out of the blue and saying, can I, it's such a relationship business. Right. Hey, I don't know you. You don't know me. Can I sell your building for you? Right. It's like, no, goodbye. Yeah. And I always tell the brokers too, call them with some kind of value. Hey, by the way, Steve, you know what? I know you own this property. And by the way, did you know such and such on another building is going down right now, or adding some value to someone like you? Your time is so precious. That's why I tell the brokers who are starting out, instead of just getting on and saying one. I even go like a whole different direction. Okay. Right. In this business, you love to do business with people you like. Yes. Right. 100%. And so like before I go into a meeting, I find out everything I can about someone. Oh, this person likes golden doodles. Right. We're going to talk golden doodles for 45 minutes before we ever talk business. Yes. Right. Steve Ludwig, he loves lacrosse. I'm going to go read everything about the Premier Lacrosse League and college lacrosse and youth lacrosse. And when I roll in there, we're going to talk lacrosse for 45 minutes before we ever talk real estate. I love it. That's great. And so like I get these brokers that call all the time, and if they catch me at the right time, oh man, I feel like in a constructive way, I break them down and I'm like, do you think your sales pitch is going to work to me? Well, this is what's written. This is what my boss told me. And I was like, well, I'm going to tell you it sucks. And I'm going to tell you that like right now. That's great. You're giving them constructive feedback though too. And this will go on for an hour. I had someone call me the other day and he's like, hey, I see this development site. Would you sell it? And I was like, no. And he goes, okay, thanks. Good. And I was like, were you going to say goodbye to me? I was like, you were going to say goodbye to me, weren't you? He's like, yeah. I'm like, did you ever think of asking if I have any other sites that I might be interested in selling? You were just calling about one specific site. Anyway, we get into this hour-long conversation. Wow. And I said, there is this other site that I have that you guys build townhomes. I have a townhouse project. I might want a joint venture. And he's like, oh, this is great. Like I should get my boss and I should give him your number. And I was like, well, don't just give him my number. Why don't you schedule the call with me? Why don't you tell your boss, hey, I have a call with Steve about this site to build 75 townhomes. Would you like to join me on the call? Right. Right. Like keep yourself in the loop. Don't just be a pass-through vehicle here for your boss to get all the accolades should a deal happen. Right. And this all goes back, for me, back to my original partner, Steve. We're driving down the road and there was this listing that we saw that we were interested in buying. And so I picked up the phone and I called the broker. And I was like, hey, this is Steve Ludwig, is whatever building still available? And the broker says, no, it's in escrow. And I said, okay, thanks, bye. And Steve whomps me in the back of the head as we're driving down the road. And I was like, what's that for? He goes, did you ask him what else he might have listed or for sale? And I was like, no. And I kind of like, kept or is it non-contingent? Or is the buyer strong? And he goes, I just said no. And he goes, okay, good. Call the broker back right now and ask him if he has anything else listed for sale. So I picked up the phone and called the broker back. And, he's like, yeah, I've got some other deals and blah, blah, blah. What are you looking for? And we got in this engaging conversation. And just that little, like that slap to the back of the head to say, hey, think bigger. Right. Right. Think bigger. Ask the follow-up questions. You have to you have to make your own luck. Right. You can't just wait for people to come to you and say, hey, I got this great opportunity. Like you got to go out and hunt and find it. Exactly. And that such a, it was a
10-second moment in my life that forever changed the way I approach business.
Right. 100%. Well, these are very, very valuable words and lessons, and I hope a lot of the viewers have enjoyed listening to it. As kind of a wrap up here, what do you foresee, in a quick 30, 45 seconds for the remainder of this year and next year in the market overall? What is your perception of what you see happening coming down the road?
That's a great question. My crystal ball is that opportunities that present themselves will be unique, that there won't be this, mass resurgence of deal volume. Right now we're seeing people throwing, darts
Right.
Very specifically and accurately.
Yes.
I don't think there's going to be a return to heavy volume. And again, when you say that, my mind thinks across all the different platforms.
Yes.
But just specifically focusing on real estate investment, I see us being able to put together deals that we've been hanging around the net for a while and kind of picking up, where we've been in routine communication with the broker, and there's a buyer or seller that, as financings start to mature, that forced sales will be happening.
Yes.
Because people will not, syndicators or investors that need capital calls to pay down their previous financing because they can't refinance out the same loan.
Yes.
The people who were first to make their capital calls to investors were the winners. The people who are later in that cycle, when people's pockets are turned out,
Right.
Those are the ones where they're not going to be able to call the additional capital.
Yes.
And those deals will start to come to market. So, we're tracking maturities.
Yes.
And we're optimistic that opportunities will come around. And then again, that persistent problem is housing shortage. California's a couple million housing units short.
Right.
And I think that what we're following very closely is the state is very heavily pushing local cities to change their zoning codes for additional density.
Which will fall right in your favor.
And that's right.
Yes, that's great.
So for
And that was the
anybody out there
foresight.
that wants to sell a piece of land, hi, we're here, we're buying, we're ready.
Yes. Call Steve.
That's right. Call me.
And ask follow-up questions.
That's right. So that's, I still think that people are trying to figure out, are we heading into a recession? Are we not?
Are we in one already?
Are we in one already? I know that, in California, again, this is where we're focused. I went to a gas pump yesterday, and I was like, oh, look, because I was out in El Cajon, which is gas is cheaper than where I am.
Yes.
Closer to the water. And I was like, look, it's down to $5.13 a gallon. And I'm like, oh my gosh, $5.13 a gallon.
Right. Oil's gone through the roof. It's $90 a barrel right now, and
Right.
oil's never going away. I don't care what anyone says.
It's never going away.
Never.
But in California, where they're trying to push it away, imagine what your electricity bill would look like if oil did go away.
Right. Yeah. Well, it's impossible. You need oil for electricity. So
Yeah,
it's just-
you have to have it.
Anyway, well, Steve, it's been a pleasure. Thank you so much. I hope that everyone here has benefited from watching Steve Ludwig. It's been awesome. And again, thank you for your time.
Thanks for having
really
me, Michael. Appreciate it. It's always fun to hang out and talk with you.
Thank you so much.
Let's do it again.
Excellent. Will do. All right. Have a great day. Thank you, everyone.